Let's continue the conversation around the jobs report. While jobs added came in just below the street's expectations, unemployment rate did unexpectedly tick lower to 4%, and wage growth coming in much higher than forecasted. We want to bring in Brian Jacobsen. He's a chief economist and strategist at Annex Wealth Management. Brian, it's good to have you. So was there anything, or is there something aside from the headline miss that's not to like within this report?
You know, it was a good report, and honestly, I didn't really know what to expect with it, mainly because we knew that we were going to be having some of those revisions. Also, there were possibly effects from the LA wildfires, also an incredibly cold period of time throughout much of the United States during that survey week. And so I really didn't know what to expect with it. So I was actually pleasantly surprised to see that it was within spitting distance of the estimate, especially considering the back month revisions, the November and December ones. So I guess, you know, kind of looking at that 3-month moving average, things are still looking pretty good. And in a way, I think this actually, I don't oftentimes like to compliment the Fed. I think most of us in the markets like to blame them for a lot of things. I think it actually shows that they made a pretty good decision to cut rates as aggressively as what they did, because when we look back, it actually did look like at that point that the labor market was beginning to stall. You know, we fell down towards 40,000 job gains per month right before they cut. So that made sense to cut, but now it's begun to come roaring back a little bit here. And so it kind of does make sense for them to now take a pause.
Yeah, Joe Brusuelas telling us a few minutes ago, it actually makes them look pretty brilliant, that 50 basis point cut that they implemented, and kind of shocked the markets here a little bit. But ultimately, as you think going forward, what this print means for the Fed's calculus from here, we're not anticipating a cut until the back half of this year, it seems like. And so what would they need to see show up in the data between now and then?
I think that the key thing that they're really focused on is inflation, even though in their recent policy statements, they have talked about the balance of risks between, you know, slower economic growth, or as far as with the job market, versus higher inflation. They say that the risks are pretty well balanced. I'm not quite sure that's true. I actually think that the risks are more towards inflation, and that is what they are really focused on. With an unemployment rate of 4%, they don't really have to worry too much about further weakening of the labor force. It's really more about the other side of their mandate with inflation. And there are enough anecdotal data points right now to point to suggest that businesses are actually trying to push prices higher in anticipation of possible tariffs. You know, when we looked at the ISM manufacturing survey, all the comments that were in there, some of them were talking about how businesses are already expecting that prices are going to be higher in the future, so they're pushing the prices higher now. So I think it actually does mean that the Fed is likely to stay on pause, probably until we at least get through the storms that could be in front of us for the balance of the winter and some of the spring.
Brian, when you take a look at these revisions, does it make you, is there anything to be, I guess, does that actually potentially even justify a rate cut at all this year? If we don't see, when you talk about the threat of inflation, I guess the better way to ask this, talk about the threat of inflation. What is the threshold that inflation needs to rise to in order for the Fed to act and get a little bit more concerned about the trajectory there?
Sure. So if we do get a one-off increase in the price level, and so let's just take as an example the threatened tariffs against Mexico and Canada. It's estimated that that could increase the price level by about 0.5 percentage point, maybe 0.7 percentage points. And that would show up as an immediate increase. So that would show up as inflation. As you move from one level to the next, that is inflation. But it is likely not to continue moving higher. Now, the Federal Reserve President, Austin Goolsbee from Chicago, I think he made a very good argument earlier this week when he talked about, you know, the companies that were able to reorient their supply chains out of China already probably have. And so whatever is still coming from there, it might be kind of stuck. And so that's the danger here, is that we don't just get this one-off increase in the price level, but maybe it actually is a little bit longer lasting, which would mean that the Fed would have to be on a much more pregnant pause with where they are with rates, or we have to see how things shake out. Maybe towards the end of the year, consider hiking.
Brian, if we can put your strategist hat on, what's the trade? Knowing in this kind of interim period, you could potentially be looking at a little bit more volatility while some of the policy decisions are rolled out, and thus the Fed also monitoring how that policy is ingested by the economy.
Sure. I think that one of my favorite areas right now, so here at Annex on our investment committee, when we've been positioning portfolios, short-term investment grade and high yield, there's a bunch of ETFs, mutual funds, or if you can do it directly, that's an area that we like because really, if you think about if it's floating rate, that base rate, say the federal funds rate, might not be coming down that much. Spreads are very narrow, so you have to be careful about quality, but we think that it's still a strong economy. And those spreads are unlikely to widen materially. So short-term fixed income is an area that we really like, but then also consider large cap growth. There's a lot of negativity. Look at the response of the market to some of the quote unquote misses from some of the big tech players out there. You know, when Google has 30% cloud growth, but the market was expecting 31 or 32%, and all of a sudden they get punished a little bit for that. Yeah, people had high hopes for them, but the reality is they're still minting money. And so we actually do still like large cap growth mixed in with some of that short-term fixed income.
Brian, when it comes to that rotation trade, obviously it's something that investors are still calling for, strategists still want to see and are optimistic about seeing. But coupling that with some of the inflationary commentary that you're just getting, if we do see tariffs imposed, if we do see a move to the upside here on inflation, how much then is that going to push out any sort of broadening that we could see in the market?
Yeah, that is one of the challenges because during the first Trump administration, 2018 to 19, small cap value and small cap growth started doing really well at the first part of 2018, but then they began to lag. And part of that was because I think people realized that even though these are more domestically oriented companies, that they are still subject to the whims of the broader economic cycle, and they have maybe unobserved connections to global trade. And it was the bigger companies that were able to lobby and get exclusions and exemptions from some of those tariffs. So I think that maybe when you're thinking about where to position things, smaller cap companies, while I do love them, and there's a strong argument from a valuation perspective, they might have a tough time navigating any sort of tariff storm that we might be embarking on here.
Brian, thanks so much for taking the time here with us ahead of the opening bell and after this report. We appreciate it.
Thank you.